and I'm the presenter of the Middle East Business Report on Sky News in London, and I'm very glad to be joined by you all today. As you've heard, this whole week we've been talking about cutting-edge technologies, AI, EVs, batteries, renewables, and this session is a little bit different. This session is about what underpins those technologies. And I'm very, very glad to be joined by Brian Mennell. He's the CEO of TechMet, which you just heard about briefly there. They achieved a $1 billion valuation last year by investing in mining operations that focus on critical metals, those metals that underpin the technology revolution that we talk so much about. So Brian, welcome to the stage.
Thank you.
Good to be here with you today. One of the issues that we face is a critical undersupply of these metals. Underinvestment is rampant, and the IEA projects that by the end of this decade, there will be a significant shortage of minerals and metals like lithium, cobalt, nickel, vanadium, and so on. And so the case that Brian is here to make and that I'm here to learn about is what is holding back that supply. And if it is such a sure thing, such a no-brainer, why isn't everyone investing in these metals right now?
Yeah. No, thanks, Edward. I mean, there are a number of challenges we face. You know, it's generally recognized that we need energy transition, electric vehicle revolution, the transition of grids to renewable energy sources in order to mitigate climate change. And it's increasingly recognize that you can't scale these technologies without radically transforming the critical mineral supply chain and producing a lot more nickel and lithium and cobalt and rare earths than we've ever done historically, and doing it responsibly. Otherwise, we're not underpinning the energy transition in a sustainable manner. There are two primary, or maybe three fundamental problems with what we need to do to transform our industry. One is timing. You know, it takes 2 or 3 years to build a lithium-ion battery gigafactory, and on average 9, 10, or 12 years to build a mine. So there's a mismatch. We as an industry needed to invest $100 billion 4 years ago to avoid the cliff of structural undersupply that is becoming increasingly unavoidable and inevitable in the next 3-4 years. And the hundreds of billions of dollars that our industry needs in order to transform in terms of volumes, in terms of ESG, in terms of carbon footprint, is not coming. You know, we are getting help from the US government with Inflation Reduction Act. The Chinese are continuing to aggressively invest in our space, having built an overwhelmingly dominant position over the last 15 years. But institutional investors are still see mining, albeit a necessary ingredient of the energy transition, as somehow an ESG and PR risk that is best left to others. And that's a massive problem. The geopolitics of our industry is also an increasingly pressing issue from a European and US national security, industrial competitiveness and growth point of view, given Chinese overwhelmingly dominant position.
Interesting. Let's take it a step back, I suppose, and just sort of touch on what these metals actually go into. You know, for those who aren't familiar, perhaps, with some of the critical metals that you know, TechMet specifically invests in. Why are they important to people, I suppose, at this conference, which is a technology conference?
Sure. I mean, TechMet, we target 7 critical minerals. We do lithium, nickel, cobalt, which go largely into lithium-ion batteries for electric vehicles, for devices, etc. We do rare earth metals, which go largely into permanent magnets for electric motors, for EVs and wind turbines and others. And we do tin, which goes into everything. And we do vanadium for vanadium redox flow batteries and tungsten. So those are some of the key ingredients of these transformative technologies. But it's not just renewable energy, energy infrastructure, and electric mobility that is driving accelerated growth in demand for these specialty metals. It's also, other areas that are much more pertinent to a lot of the people at this conference than energy, which is AI, for instance, which requires enormous amount of data processing hardware, which requires a lot of energy. So data centers are really energy intensive, and for them to be responsible and sustainable and largely driven by renewable energy sources, you need a lot of batteries and a lot of energy infrastructure, which requires a lot of our metals and much, much more than we've ever needed before. We're at an inflection point between, I guess, a couple of 100 years of a world whose industrial and technological infrastructure has been driven by fossil fuels to a future where that infrastructure is going to be largely built by critical minerals. This is an really epic inflection point and an epic supply-demand dislocation that we're at the beginning of, with massive implications if we continue to fail the world as an industry and as a market, which we are. The gap's getting bigger every day, and China's control is getting bigger every day.
So paint a picture for us then. We get to the end of this decade and, wind farms are abundant, EVs are the dominant mode of transport in terms of, vehicular transport. What does that look like when that structural undersupply, when that shortage kicks in a big way? Is everyone scrambling to then try and get hold of those metals? Yeah. And does the price then spike? Is that what the case is?
It's inevitable that over the next 3 to 10 years, all of these metals are going to have to go up much, much higher in price for much, much longer than we would like, because of the structural undersupply and the lag of 10, 12 years for the market to correct the structural undersupply, given the mismatch in the timing of projects. So that will happen. The winners, countries, auto manufacturers, industries in general, will be those that secure preferential access to these scarce resources now, and the losers will be those that don't. And the cost of losing will be very high, and Chinese interests saw this coming 20 years ago and have won a war that nobody else knew they were fighting till they lost it. And therefore, Chinese industry has a massive global advantage, which, they will obviously continue to exploit while everybody else tries to catch up.
I mean, we're in the Gulf today in Doha, and Qatar has a great working relationship with China. They're the #1 trading partner. Last year, they signed the longest ever LNG supply deal to China. Will Qatar get preferential access to China's critical mineral stockpiles? Or will that be a case of China looks after #1, looks after itself?
I think, I'm not an expert on China, and I obviously can't speak for Chinese interests, but my assumption is that China will use their overwhelming dominance over global critical mineral supply chains in two ways. One, to advantage their domestic industry relative to industries in Europe and the States and elsewhere. Clearly China Inc. would much rather sell electric vehicles into Europe to destroy VW than sell lithium hydroxide or batteries to VW. And the other way in which China will use the tool that the world has allowed them to acquire over the last 15 years is as a weapon in any escalation of new Cold War tension or conflict, which sadly will be a factor of the world we live in for the years and decades ahead. Qatar, is in a very strong position, and can play a very interesting role with respect to capacity to finance and capacity to bridge some of those divides.
I suppose the Gulf as this sort of axis between East and West has played quite a good hand in terms of ensuring that it's on the right side, whatever the outcome. On the subject of geopolitics, countries around the world are increasingly becoming aware of the undersupply of these metals and the importance of them for their efforts to hit low carbon energy targets that they've set for themselves. Mexico last year, President Lopez Obrador announced that they would start to begin the process of nationalizing lithium resources and lithium mines in Mexico. Is that something you see happening more, that countries are beginning to nationalize these critical metals to ensure a consistent supply, for future purposes?
Certainly the critical minerals supply shortage will result in those countries which are rich in these critical minerals increasingly exploiting the opportunity to use that for leverage and value, and therefore resource nationalism will grow. And in countries like Chile, which is a major lithium producer, or the Congo, which is a dominant cobalt producer, there will be a lot of populist political desire to, in some cases, sadly, to eat the goose before it lays the golden egg, and retard investment, and therefore retard the roles of those countries in this global supply-demand dislocation, but nonetheless legitimate aspirations to have more processing domestically and to leverage those resources into greater wealth and development for those countries' populations. So it is a very interesting dynamic, and whether Chile can be the Saudi Arabia of lithium is speculative, but the concentration of sources of supply gives a lot of leverage.
And as a private company, do you see that as a political risk, the sort of push towards nationalization and protectionism?
No, it certainly is.
Yeah.
And it will be increasingly a factor of the world in which we invest and build capacity and produce, and one that US and Europe will have to be very, very sensitive to and engage with in a much more proactive and effective manner than they have chosen to be over the last few decades in Latin America, in Africa, and in elsewhere in the world, where they've largely abdicated involvement to Chinese and other interests. And it's key not only to mitigate climate change, obviously to meet climate change targets, you need a lot more EVs and a lot more wind turbines and a lot more solar cells, and they all require a lot more metals. But it's also crucial from an industrial competitiveness and jobs and growth point of view as economies transition. So in Germany, where maybe 20% of the economy is related to the auto industry, an unsuccessful transition to EVs from diesel and petrol engine driven vehicles, which is now unstoppable and irreversible, can be catastrophic for the German economy and result in 12, 15 years of recession. And that's what we're looking at, because they are way behind Chinese and some of their other competitors with respect to understanding and securing their supply chains, feeding their EV programs.
So the advice to Germany would be get involved in nickel, lithium, cobalt as soon as possible.
And fortunately, learn how to assess risk and value in your supply chain, including mining, in order to invest to secure preferential access to product. And they're all thinking about it, and they all realize their concern needs to become panic, but there's a long way to go before they adequately address those challenges.
One question I wanted to ask about the traditional legacy players in the mining space and extractive space is, are they just sitting comfortably on profits from iron ore or crude extraction or whatever their choice might be? And is that what's blinding them to the opportunity in critical metals, or what do you think it is?
No, it's a very good point, because the big global mining companies are radically failing the world and failing their shareholders ultimately in leading this transformation of critical minerals industry to feed the energy transition. And the reasons why the BHPs and Rios of this world are not doing what they should be with their capacity, with their funding power, with their project development abilities, is historically because these metals haven't been big enough projects and markets to move the dial for them. So it's very difficult to deploy $1 billion in rare earth metals or tin or vanadium, and therefore it hasn't justified time and attention. And it's really difficult for a BHP to wean themselves off the model of digging up iron ore in the Pilbara in Australia and shipping it to to China and paying $10 billion dividends. You know, it makes them popular short term, albeit failing long term. And they're, you know, by their nature, big conservative bureaucratic companies that, you know, sadly are likely to continue to fail to transform.
I suppose one of the dislocations or one of the kind of, you know, tensions within this space that you operate in is the, I suppose, what would recently be called the sort of ESG risk, but, you know, I guess we could classically call just the, you know, potential for shareholders to see the downside of environmental damage that comes from the extractive space, which is obviously in tension with the renewables and sort of clean energy future that these metals can provide us with. So how do you reconcile these two things and kind of assure your shareholders, assure your partners that you're not going to provide the world with clean energy in one hand and also pollute the world whilst doing so?
No, it's a very key issue. The fact is that mining and metal processing can be responsible and well governed. It can be low environmental impact, it can be low carbon footprint, and it can be responsible in terms of community and political interface, and it has to be, and that's how our industry needs to transform, and a lot of the history of our industry has not upheld those values, and therefore our reputation as an industry is some degree unfair and ignorant, but to some extent not unfair. So that's something we have to do. And it's something that has to be recognized, you know, that our industry can and must and will be a responsible element of the energy transition.
And in order to do that, I mean, what kind of safeguards can you put in place? How do you assure people that actually you are making efforts to keep it as sort of low damage as possible?
We as TechMeta are somewhat unique in the sense that we're part owned by the US government through the United States International Development Funding Corporation in Washington, which as a US government development funding agency obligates us and audits and oversees the adherence to very high ESG standards. So we are very overseen and audited across all of our operations in North America, South America, Africa, and Europe, where we're building or expanding projects across these metals.
Okay, interesting. And then here in the Middle East, obviously, crude oil has always been, you know, the kind of extractive, it's the energy source and has made it what it is in many ways. But increasingly we are seeing moves by the Gulf countries to get more involved in mining and particularly in some of these critical metals. When you look at the future of the Gulf in terms of its efforts to diversify its economy and also to push towards these low carbon energy sources, how do you see critical metals playing a role in that future?
It's increasingly a focus of attention in the Gulf region, both from a sovereign sources of funding point of view and a private source of funding point of view. And it is for two reasons. One is that it is increasingly recognized that it's a massive area of value creation potential because of this structural short supply over the next 5, 10, 15 years. And as you say, an imperative to diversify economies, both in terms of sovereign wealth, deployment of capital and local industry, to balance fossil fuel dependence, which is obviously where these economies have come from and which will persist for many years to come, but nonetheless has a, you know, transitional horizon over the next 5, 10, 15 and 20 years. So there is a lot of appetite in the Gulf, which will make a big difference to our industry. So, you know, what's happening in Saudi Arabia with PIF and, you know, Abu Dhabi and Dubai and here in Qatar will, certainly from a funding point of view and a domestic industrial diversification point of view, become very important to global critical mineral supply chains.
On that subject of funding, obviously, you know, with higher interest rates, money supply has been, you know, weaker, and therefore mining operations, which are very capital intensive, have been harder to get off the ground. How important has the Gulf become as a source of that funding? I mean, you touched on that, but it seems like these days, the sovereign wealth funds of the Gulf are the kind of go-to place to raise capital. How important is it in that space?
It's potentially very important. It's relatively early days, and the scale of deployment of sovereign wealth sourced funding into critical minerals is somewhat in its infancy. There have been a few transactions, but it's got a long way to go, so it will be very important.
And when you look at countries outside of the Gulf, in Africa, where Gulf companies are kind of interacting with them and investing more heavily in East Africa in particular, that's a space that traditionally has been the preserve of Western mining companies and South African mining companies as well, where you're from. How do you see that region changing as well? I mean, obviously, Congo has a huge source of cobalt, which is an important mineral for all of our cell phones and things like that. How do you see that region being shaped by this kind of rush to critical metals?
It's certainly the role of resource-rich countries in Africa, Latin America, and elsewhere in the world in this supply shortage and in this new Cold War geopolitical landscape overlaying critical mineral supply chains will be a crucial definer of success, development, and conflict, as it was in the last Cold War. So how countries like the Congo manage the balance between Chinese interest, which have been totally dominant over the last 10 years, and non-Chinese interests, which are trying to catch up, and then Gulf sources of funding and interest, which sit between the two and perhaps balance that conflict, will be a key definer of success and stability.
Do you ever worry about a world where raw materials aren't required or aren't necessary? I mean, at the moment, we're using more raw materials than ever, and the transition to net zero and low carbon energy sources is only going to continue to fuel that. But do you see a world where there isn't a need for those kinds of metals, or is that just a sort of like a fantasy?
I think it is a fantasy in a sort of 50, 100-year horizon. I mean, who knows, looking out into the far distant future. But all of the transformative technologies that we're talking about here at the Web Summit, and that will continue to change the circumstances of the world, are dependent on hardware. They're dependent on energy, and they're dependent on systems that require metals to produce them on greater and greater scale. So, a non-resource dependent world is a very remote and unlikely scenario.
Yeah, we do live in a material world. I mean, Ed Conway, my colleague, he wrote a book, and he talks about we are ethereal beings living in a sort of digital world, but it's all fueled by things that we still pull out of the ground. And so I suppose one of the last questions I want to touch on before we wrap up today is, what does the future look like for TechMet specifically? What have you got in the pipeline? Can you share with us anything today about what you're working on?
Yeah. Well, we're busy expanding all of our 10 operating companies around North America, South America, Europe, and Africa that produce, process, and recycle these critical minerals. We're raising another $300 million now to accelerate our investment and expansion programs and to add to our portfolio with other lithium, nickel, cobalt, rare earth, and other projects. So we'll continue to become more and more relevant as we grow our scale and grow our portfolio, in alignment with high standards and with US and US economic allies' supply chains. So we're just going to do more of the same, in the pursuit of our mission to be a responsible provider of the ingredients mitigating climate change and furthering the energy transition.
And what about those people in the audience who say, well, this sounds great, TechMet sounds like a great bet, I want to get involved? Any plans to IPO one day or open it up?
Well, we do. We're a private investment company, and we're owned by the US government with some institutional and I think now 90 family office shareholders. So we are open to investment. We're not open to retail investments, and we don't have any immediate plans to IPO. So we will remain a private investment holding company. We're domiciled in Ireland, and we do raise money and deploy capital, but from large family offices, institutions, and sovereigns.
Right. So the message is, if you're a family office or a big financial institution in the audience, then talk to Brian afterwards. But if you're like me, just a regular person, then don't bother him, please. I think that's all we have time for today, but thank you very much for joining me. Brian, thanks so much for sharing your time with us today.
Very much, Edwin.
Cheers.
Thanks.
Thank you.